I'm Simon Brown, still here with the second session this morning. I'm going to be chatting with Carla de Waal, Multi-Management and Manager Selection Head at FNB Wealth and Investments. Carla's got some 20 years in the industry, so what we're seeing right now with weak markets, certainly she has seen that before, and is a CFA charter holder. Carla, thanks very much for joining us virtually today from Cape Town. I'm going to kick off with you. You've got a presentation that you're going to do for us quickly. Then we've got some Q&A. Folks, as always, if you've got questions, events@moneyweb.co.za, you can send them through. I'll put them to Carla over the next half hour while we're chatting here. But Carla, appreciate the time this morning. Let's start with your presentation.
Good morning, Simon, and also a warm welcome to each and everybody that joined us this morning. This is a first step in becoming a better investor, and I hope to be sharing today some strategies that I believe will help you to become a better investor. Now, the first couple of slides, I think if we can go to the next slide, as everybody is well aware, we have seen a very volatile period since the start of this year. And yes, inflation seems to be threat. This slide shows the VIX and the South African Volatility Index. We haven't reached those levels of volatility that we saw during the COVID crash, but if you look at how volatility has crept higher, it has definitely been one of those things that had rocked the boat a bit. If you look at a fear and greed index, we are firmly in the territory of extreme fear. And also, if you look at the next slide, what we've been observing over recent years in the market, if you look at the constituents on the next slide of the top 40 index and how those individual stocks have exhibited higher levels of volatility. This slide just shows us the daily moves and how the daily moves of those top 40 stocks before the COVID crash have been the type of experience that investors have had during that period, and how that daily moves have jumped up materially in the period after COVID. So I think as an investor, we are here now in almost at the end of June. We see global equities down more than 20%, global bonds also down double digits, local equities almost 10% down, local property also over 10% down. Local bonds have kept up relatively well, even though it's been underperforming cash, so not an easy ride for investors. And it is never to see those negative returns, and I think this is the time where we need to help our investors to become better investors and give them a strategy to do so that will help them through these volatile times. So what I wanted to present today is what I call the BEST investment strategy. It's an acronym that will be easy to remember, BEST, and I believe that will help you to become a better investor. The B standing for behavior. That is your behavior as an investor that will be a main determinant of whether your investment strategy will be successful or not. The E in the word BEST, or the acronym BEST, stands for experts, and this is where I think there are people like a multi-manager or a financial planner or a financial coach to help you on this journey. And then S is something that I, as a multi-manager, is very passionate about, and that stands for spread. So the idea of diversification in these type of market conditions. In fact, in all market conditions, spreading your investments across multiple different sources of risk and return will be a good strategy to help you sleep better at night. And then lastly, but not least, is the T, and the T stands for time. Time in the markets, and not trying to time the markets and try to call those peaks and troughs. I believe that this BEST investment strategy will help you to become a better investor. If we can go to the next slide. This is something that we've been observing. It is interesting to see how some of the correlations earlier this year between equities and bonds have become more correlated, and I think that is, if you see what's been happening in the markets over the last few years, that would be why we are seeing this type of thing. So the question is always, how do you build a more robust portfolio, a more diversified portfolio, that even in times like this, when your equities, that is normally a growth engine in your portfolio, and then traditionally you've used bonds to balance some of that exposure in your portfolio, but now that correlations have become closer together and both are in drawdown territory. If we can move on, I think what we'll present is that you need to think about additional potential sources of return in your portfolio, a more robust portfolio. It is always then good for investors to try and understand what's been happening in markets, what has been driving this volatility, inflation being a main culprit, and where this inflation has come from. I think we can, there's a lot of things happening at the same time in markets, and a lot of this came from, yes, a lot of this is still a resultant of what we were observing and seeing during the COVID crash. If you think about the supply chains and the energy crisis, that has definitely still spillover effects that the markets and the global economies are currently dealing with. But I think the roots of some of these issues you can even trace back a bit earlier to the global financial crisis, and what central banks had to do in those periods to try and get economies out of those slumps. In this, we can dig into those details perhaps a bit later, but I think what we just try to show in this slide is that this diversification between different types of asset classes can still be a good strategy in your portfolio, especially for crisis times. And because we are all human and none of us has a crystal ball to try and predict what's going to be happening in markets, the best strategy still remains to have a balanced approach in all periods. It's because of that inherent uncertainty that we need diversification. Yes, that does mean might be giving up upside when markets are rallying, when growth assets are doing well, but there's just no way to predict and to know when those markets are going to turn around, and then you already, by the time that happens, you want to already be in diversifying assets that will have a stabilizing effect on your portfolio.
Carla, I appreciate that. And I got to say, I really liked your best analogy there: behavior, expert, spread, and time. And if we come to the behavior part, you and I have both been in the markets. We've seen these types of markets before. We don't like them, but they happen. A lot of investors, before January of 2020, you'd had a decade of really great returns, particularly in developed markets, offshore, thinking tech, but the US markets generally. I think it's come as quite a surprise to see that collapse in early 2020 and to now have another sell-off experiencing. And it really is that ability to have the right behavior, which is, in a nutshell, almost do nothing if you possibly can.
Yes, it is a very uncomfortable place, and it always feels like you need to do something, or even your financial advisor need to do something now to justify the fees that they earn. But often doing nothing is a good strategy. Because it is impossible to predict the future, we believe a solid approach is to always have some safe haven assets in the portfolio. And then in times like this, you need to trust your investment advisor. You need to trust your experts that you've appointed to help you on this journey. And you need to behave. You need to continue with your investment plan. The only time that your investment plan needs to change is if your personal circumstances change. If you get married, if you have those type of big structural shifts in your personal life, that warrants a real look at your investment plan. But your investment plan is set up to give you an outcome sometime in the future. And if you are now trying to double guess and try to make emotional driven decisions, follow the herd in that sense, and when everybody is fearful, you pull out of the market, there is absolutely no way that you can participate in the recovery. In all of the previous periods when there were pullbacks in the market, there has been a recovery. What we don't know is how deep that drawdown will be before the recovery starts, then how quickly that recovery will take place. The COVID crash was very deep, very steep, very quick. But the recovery out of that was even quicker, and I think that took a lot of market participants by surprise, how quickly markets recovered from that, even to the extent that many areas in the world or markets actually overheated, in the United States perhaps. And I think that is also just making the whole system much more volatile. So even though we don't know what's going to happen in the future, I believe that we are going to see this persistent higher volatility with big moves up and down within stocks, within different sectors. We see it in different managers and how they perform. And again, this is why we would say it won't help you to try and time when to be in the market, when to be out of the market. There's no way that anybody can get right. Rather, at all times, have a balanced exposure with multiple different levers that can perform in these type of market conditions, or at least be a cushion for other areas of the market.
I want to touch more on diversity. Before I do, there's a question that's come through from Andrea, which I think in some senses really hits it on the nail. He makes the point. He says he's already invested in the US. He's got offshore funds. Is this a good time to invest more? I mean, do we look at something like the sell-off in the US and say, well, maybe it's time for a little more allocation there? Or do we take the view that carry on doing what you were doing ahead of this? In other words, you had the plan and keep that in place. Or is there some wiggle room, particularly I'm thinking tech stocks, which are markedly cheaper? Now, we don't know, they might get still cheaper still, but nonetheless, they're off around a third, in some cases, a whole lot more.
Yes, so again, the first thing would be that you need to stick with your plan. There's just no way to know how all of this is going to play out. We don't know whether the Fed is going to make policy errors. We don't know how much this fears of inflation in the system is going to create further volatility. Those tech stocks, even after the sell-offs, still make up quite a large portion of the S&P 500. I would again go back to the best investment strategy and see this is maybe the time where your expert can identify some tactical or shifts or areas, not changing the investment plan, but they will be able to identify areas in the market that provide some potential for better returns or lower volatility going forward. Just one example here is that everybody has shunned some of the emerging markets, and China in particular last year. and perhaps there are a case to be made now to start adding a little bit to that, not to go overweight equities, but there might be some opportunity there now to start adding a little bit of China exposure. It is an uncomfortable trade now, given what has been happening and all the pain that investors felt recently about that. But again, there are teams of experts that can help you along this way, that you are not alone in making those decisions. The question around your exposure, I think, came much more to the fore earlier this year, with National Treasury increasing the allowed offshore allocation for institutional investors. We believe it is a good thing to be able to be more flexible in where you take your allocations and your exposures. Having that ability to have more offshore will increase the potential universe for better diversification in your portfolio. But this also could lead to more differentiated outcomes. There are more places where you can make errors as a result of this. And again, why I would advise that the expert part in your best strategy could help you with that. A multi-manager that can analyze all of these different skill sets of the managers and identify which one would complement your existing portfolio to keep you on track.
I like that, and I like the expert part. I like your point in China being perhaps uncomfortable, and from my experience is that's often the time to be doing it. When everybody else is in the trade and it's more about FOMO and fear of missing out, you've probably missed out already. A small bit of discomfort. I want to come to the S and best, which is the spread part, which is that diversification. You made the point that back in the days you would find equities and particularly bonds often sort of inverse to each other. You showed the slide of 2008 where equities gave negative return, but bonds gave positive return. We sit here in 2022 and those correlations are so much tighter. We're seeing sell-off across the different asset classes. That, in a sense, some folks would say, well, then why diversify? But we're looking at it for that longer part of the process. We're looking at it for the different characteristics, not just in 2022 during a market sell-off, but broader in terms of the longer term, in terms of the volatility within the portfolio. And that spread, that diversification is still, as Warren Buffett would say, the only free lunch we get in the market.
Absolutely. And I think all of these things are linked together and interrelated. Your expert can help you with the behavior part. If your portfolio is not suitably diversified or spread, then there will be too little levers to create a robust portfolio. Time being of the essence. I normally use the analogy of baking a cake. Mm-hmm. You might have the recipe to a T. You might even have roped in some ideas from master chefs, and then that batter needs to go into the oven. And if you open that oven before the time is up, your cake will flop. Now, sometimes life happens. Can interrupt, for example, the baking time. And what do you now need to do? You might need to extend the time that cake sits in the oven to increase your chances of getting a successful outcome. So again, all of these things work together, but at least if you follow this best strategy, that will help you sleep better at night.
Yeah, I like that absolutely. A question coming through, which again ties into the being diverse, having that spread of investment. And the question was, is there a safe haven right now? A lot of folks would traditionally say, well, it's about cash. But except that inflation is eating away at your cash. Is this almost a case of that there are going to be points in an investment cycle, and perhaps we're in one of those now, I think we could say we probably are, where there almost isn't a safe haven, and we kind of just need to revisit our behavior, to revisit our strategy, perhaps go and have a cup of tea or coffee with your expert, and hold on, because it's tough out there, and there is nowhere to hide almost.
That is true, but like insurance, diversification is uncomfortable thing that to have, because if you could perfectly predict the future, you didn't need diversification. If you knew for a fact what asset class would be performing well, then why give up some of that upside returns? So diversification is a necessary compromise. And now if you think about a safe haven asset, that is similar to having insurance, short-term insurance, a bit of a grudge purchase most of the time, but you just simply don't know if and when your car is going to be in an accident. So you insure it all the time. And I think that is why you need to think about a safe haven asset. And that is why in our analysis and when we build outcomes-based portfolios for our investors, we always include things like cash as a strategic asset allocation. Small, because if you want to keep up with inflation, you can't have all of your assets in cash. That is the one asset class. And I think if we can bring up the slide again, the slide pack again, the last slide there shows that you have very little chance of outperforming inflation if you sit in cash.
Yeah.
Now, the other safe haven asset that we really like to have a strategic asset allocation to is gold. Gold is not on this particular slide, but if in a changing world like this, gold is still a good component to consider, to have a small strategic asset allocation, because it is so difficult to time all of these things. And in our analysis, we've seen it doesn't really help to try and, when things become sour in the markets, now to start increasing your gold allocation. Some questions are always coming through around, okay, cryptocurrency, is that something to consider? The problem is that gold is still considered to be, by central banks, a store of value, and cryptocurrency not yet. With cryptocurrency being so extremely volatile, it doesn't a large allocation, but it will take so much cost and time to try and research that it's almost not worth it. So we still prefer gold as to play a big role as a safe haven asset in such a diversified portfolio.
Yeah, I hold gold. I was criticizing it the other week and saying it hasn't done anything. And then I realized it was flat year to date. And I realized, actually, you know what, flat year to date is the new winning, because I don't think there's much else in my portfolio that is flat year to date. So we'll absolutely take it. What about, and there's some questions coming through around the ETF and ETN. And in many cases, we look at that and it's passive. But that's not always the case. F&B's got those ETNs that are listed on individual stocks. But the question coming through is some of them, and again, let's stay with F&B, there's the clean energy ETN that is available on the JSE. And of course, we can buy the same underlying ETN in New York in dollars. Is there a logic to one or the other? Is there a process to say we're better off buying the one in rands on the JSE, or we're better off buying the dollar denominated in New York?
Again, those decisions will your expert or your financial advisor or financial planner will be able to look at your individual circumstances and how all of these different instruments would fit into your plan to help reach your investment journey. I think what is exciting about these instruments is how easy it makes for anybody to participate in markets, to very quickly get efficient access to different areas that was previously perhaps a bit more difficult to get access to. So yes, they can play a fantastic role in the portfolio. And if you just think about how popular ETFs and other passive products have become, at F&B, we don't believe you need to go either one way or the other. We believe there's a lot of value that you can get in your total portfolio when you blend active and passive in your investment solution. It's not either or, it is both. You need a lot of beta in your portfolio to deliver that growth over time, and ETFs and passive products can be a very efficient and cost-effective way to get that beta exposure. And then around such a core of the portfolio, it would make sense if you want alpha or performance that's different from the markets, to add some active investment managers that follow active strategies to help build a more robust portfolio. And that ties back to the idea of spread diversification.
Question coming from Ray asking if there are fee-based advisors available, and certainly there are, who will charge flat fees. No names come to me right now, but I mean, if you Google around, you will find a bunch of them out there. Be warned, you're going to look at that fee and think it's a chunk, but if you run the numbers, often it's worthwhile if you want a one-off. Carla, coming back to you, we're talking diversification, and in a sense, some folks will say, but hang on, I've got myself a diversified portfolio, I've got sector diversification, I've got asset class diversification, I've got currency and geography, and I've got everything, and I'm still losing money. It's not a silver bullet. I mean, that's not what we're promising here. We're not saying that this is the secret to not losing money. What we're saying is it's the secret to sustainable long-term, because the inverse of diversification is putting 100% of everything you've got in one single stock. It doesn't matter what the stock is, that's going to be scary.
Absolutely. And again, we are all humans. We feel pain far more than what we feel the opposite of pain. And diversification is of a risk management strategy. It is there to help you sleep better at night. And then to get back to the best acronym and the best approach, you need to trust your investment advisor then. You need to trust your investment managers who have been through multiple market cycles to navigate your portfolio through this. It won't help if you now try to double guess and second guess them. You are likely at an information disadvantage against a lot of other players in the market. And the best thing that you can do is look after your behavior and rather stick with your investment plan. Don't try to make emotionally based decisions. Enjoy your time with your family and let your investment expert make these difficult decisions when they are required. And sometimes doing nothing is what is the best approach at that point in time. If you then have a diversified portfolio that are appropriately spread between different sources of risk and return, and if you then sit in the markets all the time and can sit through all of this volatility, then we believe that is a solid foundation by which you increase your probability of reaching investment success.
Yeah, I like that. And it comes back to, one of the questions I wanted to ask was around weightings, because the question is, how much should I have in gold? What about all the best? And it comes back to that expert, because it's going to be slightly different for everyone. It's going to depend where I am in my part of the process. We're going to leave that there. That's Carla de Waal from F&B Wealth and Investments. Carla, really appreciate the time. Really like that acronym. BEST, which stands for behavior, manage your behavior. E for expert. Find an expert who can help you spread. You've got to be diversified. There's different ways of doing it, but we have to be diversified. And then, of course, the T in BEST is for time. Time is, I said it in the first session, it's the biggest asset we have when we're investing. Give it time and don't panic when markets do what they're doing right now. This is what they do sometimes. Trust me, seen it, been here before. We'll get out of it and there will be another one. Carla de Waal, really appreciate on the line virtually from Cape Town. Ladies and gents, that's me for today, but there are, of course, more sessions coming.